Hi, I'm Rick Kaler. Thanks for joining me. Around 12 years ago, the South Dakota Investment Council combined two of their asset classes, domestic and international stocks, into one, global stocks. While this move didn't make the nightly news, it did signify a growing trend. Many investment advisors no longer view the U.S. stock market as a separate asset class from the rest of the world stock markets. Today, they view it as one component of a global asset class of stocks. For the same reason, you don't want to own just one company's stock in your portfolio. It makes no sense for an individual investing for retirement to own just U.S. stocks or just German stocks or Japanese stocks. It's as important to diversify among countries as among companies. The question then becomes how much of a global stock portfolio should be in U.S. stocks and how much in international stocks. For many years, the standard thinking of portfolio managers was to over-allocate to the U.S., called the home country bias. It was, and to some degree still is, common to see 80% of a portfolio's equity allocation in U.S. stocks. Now, that over-allocation has never made a lot of sense to me, considering that the U.S. accounts for far less than 80% of the global market capitalization. In the 1980s, U.S. companies accounted for about 65% of global capitalization, and accordingly, I weighted my stock portfolios with 65% U.S. and 35% international. But by 1999, the U.S. had slipped to 50%. I adjusted my portfolios accordingly. The latest statistics that I receive from Dimensional Fund Advisors show the U.S. still accounts for around 50% of the global capitalization. So investors who want to maintain a true global diversification of their stock portfolio are going to need to seriously consider reducing their U.S. allocations to 50%. Now, which international stocks should you add? Well, developed countries like those of Europe, Japan, the region of Australia-Pacific account for about 40% of the total global capitalization. Emerging market countries, many in Southwest Asia and Latin America, make up the remaining 10%. Weighting your portfolio accordingly gives you a well-diversified stock portfolio that has a high probability of withstanding the inevitable rise and fall of equity markets. So how do you invest globally? Well, there are mutual funds that invest in specific countries, in regions, internationally, or globally. Now, I don't really like the country funds, as I don't know which countries I should be underweighting or overweighting. Besides, creating a global index using just country funds can be a lot of work and a lot of expense. Using index regional funds is an easier way to invest in international stocks. To allocate according to the global capitalization percentages above, you should include 3 index mutual funds in your stock portfolio. One broad market U.S. fund, an international fund of developed, which would exclude non-emerging markets, and then an emerging market fund. If you want even more simplicity, invest in one good global fund. The difference between an international fund and a global or world fund is the global fund is going to include U.S. stocks, where an international fund won't. Now, Vanguard's Total World Stock ETF comes to mind as one of the better one-size-fits-all global funds that will invest in a mixture of countries, including the U.S. This one fund holds 7,164 stocks, to be exact, in 47 countries. You really need nothing more in the equity portion of your portfolio than that one fund. While it isn't necessary to allocate your stocks strictly according to global capitalization percentages, research suggests you probably will do better in the long run to do so. Whether you decide to own country, regional, international, or global funds, What's most important is that you diversify your stock portfolio globally. In today's world, it's an important component of diversified investing. Thanks for joining me.